I've been trading for over 7 years now and I made quite a bit of money from it. And if I had to start all over again, this is the exact video that I would use, even if I had zero knowledge, because we're going to go over exactly what options are, how to set up your trading software, all the way to the exact strategy that I would use to make my first 6 figures if I had to start all over again. And this is going to be the only video that you guys need to start to profitably day trade options. And the best part is I'm giving all of this away for free. Starting with what exactly is options trading. Now, options give you the ability to buy 100 shares of each ticker. For example, if I wanted to buy 100 shares of Tesla, I could buy one contract that allows me to buy 100 shares at X price. So if I buy 405 calls, then I'll be able to purchase 100 shares of Tesla for $405 a piece. Now, when I first got started, I was like, what is that? How does this apply to me? And this is very confusing. I also thought when I first started trading that if I was going to buy 405 calls, the stock needs to go to 405 for me to even start making money. And that's simply false. I'm here to give you guys the information that is needed to actually options trade. And knowing how these options work, options is just the vehicle to get us from A to B. Basically, in simple terms, it's leveraging the stocks that we're already trading. For example, if Tesla goes from 405 to 406, I'll make 0.5% if I was actually trading shares. Now, for example, if it goes 405, 406 and I'm trading options, I can make 10% from 405 to 406. 10%. So to recap, options trading is basically leveraging each and every single stock. So instead of me making 0.5%, if I was going to trade shares, I can make 10% on the same exact move. How do we trade these options? What brokers do we use? There is one broker that I've used for years now, and that's something called Thinkorswim. There's others out there like Interactive Brokers, there's Webull, there's Robinhood, but I like to keep it simple. Thinkorswim, as you guys can see right here, is exactly what I use. At first, it's going to seem super hard to navigate through this whole thing, but like anything else you ever done in your life, things take time to fully understand and grasp. I'm telling you, this probably took 2 weeks to fully figure out, and then I was good to go. Do not get intimidated by this software whatsoever. And if you want to make your charts look exactly like this, let me go over a little tutorial. As you guys can see, there's this beaker icon and there's also the settings icon. I'm on the 1 minute chart right now. The settings icon, we're gonna go here. Overlap volume. People are like, why do you not have volume on your screen? I'll go over that in a little bit. But for right now, I use something called time of sales instead of volume, which is basically the same thing, but better. This is my settings right here. Then I go to appearance. As you guys can see, I fill these up, change the colors if they're not changed already. Get rid of this grid. I do not need a grid. Change the background color to black. Then I go to equities. Instead of show volume subgraph, I have that off. I usually have this off as well. Highlight extended hours and boom. Now you guys can come down to here. You guys can see this icon right here. You can move this back and forth. We can zoom in. You guys can make key levels like this. If you guys need to edit it, you right click it, edit properties, 405. Now, if you guys want to create lines like this, where it has an arrow, you went to there, you right click this, edit properties, color, style, width, and then you guys can see arrow type, you hit OK. And if you want to save this for every single time you do it, you just save as default. For example, if I want this defaultly orange, save as default, go here, everything's orange. But if I want this to be blue, for example, like I had it previously, we go here, make this blue, save the default, and now every single one is blue. If you right click the whole entire thing, clear drawing set, you clear everything. How to execute on here? You guys see on the right side of this, you guys see active trader right here. You're gonna click that, move this down, and I execute everything on Dash, which I'll talk about later, but this is how I used to execute when I first got started. Auto send, you wanna make sure everything's auto sended. We don't wanna get in and we have to confirm that we wanna get in. No, if I click the button, I wanna get in. Some buttons that you guys wanna use, I mark it every single time that I get in. So if I click one, buy market, this will buy 1 share of MSTR, for example. If I switch it to Tesla, it will buy 1 share. You might be like, Lander, I'm here for options trading. I'm gonna go over how to trade options with this active trader in a second. Right now, we wanna make sure that all of these are on here, right? You guys can screenshot this, whatever. Buy market, sell market, cancel, reverse, flatten. This buys, this sells, this cancels all orders, this reverses, you don't really need that at all, and this flattens. So this gets rid of, if you have an open position, flatten it or sell market, either one works. You guys can also change the quantity in your actual trading settings as well. So you guys can have the buttons right there, or you could just go be like 50. and then you can buy market like that. Now, how do we make this into an options trading? You guys see this thing right here. You make two of them. Get rid of that. Let's type in Tesla, for example. And this is what the charts look like before it gets landerfied. Now, active trader, get rid of the chart, boom, now we have 2. Move this back over. See this little middle thing right here? You move it over, make this a little bit bigger, auto send. Now, instead of it being Tesla, we could change it to options. Look, options is right here. Make this Tesla, one of these. Now we could trade options with that. Options chain is also right here. Take a look at Tesla. As you guys can see, options chain, you go here. Now we have the options chain right here. Now what you could do is link this to 1. For example, let's just say 1. And one of these, you could right click this. Then you could send to 1 and watch this. There's your contracts. Let's say you want to get NVIDIA contracts. NVIDIA, we're in the 1s. We go here, right click that, send to 1. Look how fast you can do it. Boom. Now you can buy. Move this down to make it look better. Let's do one more. SPY, right? We're in this options contract. Right click that, send 1. Boom. You buy. Like that. Now, how do we know what contracts to buy? Well, let's take a look. Let's go to NVIDIA, for example. And this is how I buy every single contract that I've ever taken, right? Let's get rid of this active trader. Let's make this a little bit bigger so you guys can see the entire thing. Let's make this 10, right? What I like to look for, and let's go to the 20th just because we're about to expire. The technical terms behind the options contract is I like to look for 0.4 to 0.6 delta. And if you guys don't know what that is, that's called something called the Greeks. And you guys really don't need to know that, especially for how I trade, because every single time the Greeks are in the right spot when we are taking contracts in the middle area right here. So let's make this smaller. Contracts in this area will have delta of 0.4 and 0.6. And again, if you don't know what that is, you really don't need to know that, right? I don't need to overcomplicate it. But 0.4 to 0.6, around 0.4 to 0.6. That's all you need to know. Now, what I do look for is volume, right? Volume in this area. What has the highest volume? Also, when I'm trading SPY and Qs, I want to make sure it's over $100. Well, Lander, this says $2.50, $3.50. This is times 100. So 3.5 is actually $350. 2.7 is actually $270. So I always look for over $100. The other thing I like to look for is what has the most volume in that area, right? Around that middle area, which is technically called at the money or in the money or out the money. Now, out the money is strikes that are above price for the call side. And if you guys don't know what calls and puts are, calls basically means that you want the stock to go up, right? So if I'm taking a trade, let's say 435 to the upside, and I think it's going to keep going higher, for example, I am going to take calls. Now, if I think it's going to go lower, this is how you can make money on the downside. You can make money when the stock's going down by getting puts. So if I get puts at, let's say, 434, and I think it's going to go to 433, I can get puts, and every price below that, so for example 434, so if the stock is at 434 and it goes to 433, every strike under that, which is this, would be out the money because it's not there yet. At the money is when the stock is right at its strike price. For example, Tesla is right around this 431 area, which is right in the middle of this. So this is at the money. Out the money, since it's not below 430, is all of that. Out the money for call side is anything above 431. So 432 and a half, these are all out the money. We want to find at the money right in the middle of this area. Then we want to look for the most volume. So if I was going to play an upside trade right now, I would take 430 calls. I want it to go up. My trade plan tells me to get in because I think it's going to go up. I would see what contracts look the best. I would see where the volume's at. 46,000 volume versus 9,000. I'm going to get in there. 430 calls. It's right at the money. Technically, it's in the money, but it's at the money right here. And that's when I would enter with those calls. The reason why I want to make sure that we have a lot more volume is because I want to be able to get in and out as soon as possible. If I'm getting in a contract that has very little volume, that means there's lower liquidity than the other contracts. I want to make sure these are liquid enough for me to enter and exit as soon as possible. So now we know what contracts to take. Let's take a look at an example real quick so we can fully grasp what we're talking about. NVIDIA, for example, if I'm going to enter on this move to the downside, I think it's going to go down. I would get into puts. As you guys can see, puts right here. I would go to the most liquid contracts right at the money, which is 25,000 versus 16. I would get in here. It's right at the money. This also is over $100. I would enter with those contracts. And all you do, right click this, you send a 1, and your 1's gonna be the active trader, and boom, you click enter. This is how you get into it. And auto sends there, you're in like that, you could sell like that. Today, we're gonna be going over exactly how I find my key levels to make me the profitable trader that I am today. Key levels are the most important things. So without these, we don't even know where we're trading at. Because if you enter at the wrong price, then the whole thing is flawed, because your entire plan is based off of that key level. And this has allowed me to have an 87% win rate for 2024 so far. Going over exactly what a key level is real quick in the simplest terms ever, it's basically a price level that has the most reactions in a certain area. That if price was gonna break out of that certain price point, that it would react exactly how we liked it to react, as you guys seen in every single live trading video, unless we take a loss, which allowed me to capitalize thousands in literally seconds up to minutes. Now, literally a month into actually learning how to find these key levels, you'll be able to do this in literally 5 minutes on every single ticker. Like I usually trade only 4 tickers, and I get that done in less than 5 minutes, because even though this is the most crucial part of your plan, because this is literally the foundation to your trading plan, it literally is the most easiest step if you just allow yourself to think of it in a more simplest terms. Now, we're going to start off with the 1 hour time frame. Why? Because I found that works the best. That works the best for me. And if it works the best for me and that allowed me to make the most amount of money, then why would I stop using this 1 hour time frame? Now, taking a look at Tesla, because this is something that I trade. Now, sometimes I have to go to the 4 hour and daily key levels, which is usually rare, but just in case the 1 hour doesn't look the best, I usually will go to that 4 hour or daily, or I'll skip the entire stock itself for the day. Because if it's not 100% clear, then what's the point of me even looking at that when I have 3 other tickers that I could potentially look at? Going into the key level, we're taking a look at Tesla here, and the main thing that I'm looking at right now, looking at this chart, is where is price reacting at the most and the most consistently. Now, the thing I want to look at is psychological level. That's usually where I want to see price reacting at. And why? Because when people buy or sell a stock, they'll put the limit orders, and they won't put a limit order at 191.54. No. If you're reasonable, most people will put their limit orders at 192, 193, 195 psychological levels. And this is why 0s and 5s actually usually have more reaction depending on price action and stuff like that. But because people would rather sell at 190 than 191, just stuff like that. It's all psychological. Either way, I'm telling you what works best. Who cares about the backstory? 190, 195, 200, those usually react the most, but 192 could still react more than 190. It's just a matter of finding these levels in the first place. Now, just because it's a psychological level does not mean we're going to take that trade. You guys can see 189 psychological level, but that doesn't mean we're going to take it. Why? Because you guys can see it's not reacting well. How do we know that 189 is not reacting well? Well, if we take a look at 189, right, and we draw it out, we can see exactly why. Now, a lot of people, if you're watching this and don't know what key levels are, you have no idea what I'm talking about. So let's take a look, right? We look at this. The best reactions is when price is clearly reacting at a certain area, not above or anything like that. Now, this would have been fine, but then price closed above it. We don't like that, right? Because then there's another psychological level, a level above this that is reacting to better. We always want the best key levels, because let's say it broke 189. Well, what happened when it broke 189 last time? We came up to 191.6 and then immediately dropped. So there's obviously something there, and we could find a better reaction point, and that's exactly what we're going to do today. But I'm just showing you guys an example of a bad key level. I wouldn't take that. Now, we want to look for the biggest and the best reactions, and for right now, Tesla's not it. I mean, you could potentially trade 189, but for the sake of this video, absolutely not. Now, we're taking a look at NVIDIA. We clear all these levels, and we're going to go up to this 134. Now, this is all-time highs, 134. This is an easy key level. Now, just because we have a key level of 134 does not mean we're going to take it once it breaks 134. This is where time of sales and everything like that comes in, and you guys can watch it up there. But for the video's sake, we're only looking at key levels that we could potentially take, right? Because every single key level that we make is a potential trade. It's not a guaranteed trade, because if it comes up and it's so choppy, so slow, time of sales is super slow, buyers aren't there, sellers aren't there, we can't take it. But these have the highest chance, and these are where the areas that we're looking at price-wise to potentially take a trade. So 134, because it's all-time highs, 133.79, Why are we going to mark 133.79? Because that's all-time highs. Obviously, price reacted there before. It might react there again, and we want to make sure what's going on in that certain area, because if it starts reacting there, it's for a reason. And NVIDIA might not be the best example either, because we're at all-time highs, but we could potentially find a downside key level. So we go out, and you guys can see there's already reactions right there. This is what I want to see. I want to see price come up and absolutely die or bounce crazy off a certain level. You guys can see bounce, 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 bounce. There is a level down here, right? We also came up and rejected this certain area. These are all key levels. Now this broke out, but I'm pretty sure we took this 125 to the upside. 125, you guys seen it rejecting this high right here. This is what I also marked out. The high of this is 125.59. So we want to make sure that if we get in above that 125 and it starts reacting here, we already start to take some off if sellers are starting to take control at that 59, because look at what happened last time. We dropped all the way to 119. So we marked that out just in case, if it starts reacting there, it's for a reason. 125, and that's our upside level. You guys seen it ran all the way to around 127. A $2 move on NVIDIA on a Wednesday, that's an easy 30%, 20%. That's all you need. But we're looking for the closest downside level for NVIDIA right now. Potentially 130. Why? Because it's reacting here. What I don't like about it is this pre-market level right here. And then it also reacted here today. Now, if it already broke and looked disgusting, then I'm not going to take it. And then this is where we go into that 1 minute time frame. Oh, 1 minute time frame is a little too small for you guys. Well, listen, this is exactly how my win rate is what it's at. Because how do you expect price to react exactly how you want? And then you look back, if you're trading on the 1 minute chart, which is exactly what I do, and it reacted terribly. Like, for example, if you had a level right here, and then you go to the 1 minute chart and it reacts there previously, what makes you think it's going to react super nice like this breakdown right here? What makes you think that, right? It's just not how it's going to work. So if price reacted like this at our key level, it's not going to react any better. It might, but you have a smaller chance of it reacting better than what's doing here. Now, even this, right? Look at what happened at 130. It broke 130, dropped like 50 cents, and then came right back up. That's not a breakout that I like to see, right? That's not a breakout that I want to be a part of, nothing like that. So 130 is eliminated. This allows us to eliminate more trades that we could potentially get faked out on and wait for the absolute best. This is why our win rate's 87%. Nobody's doing this. Again, NVIDIA downside, I'm not touching that. NVIDIA upside, 134 to the upside, that's something I'm looking at. This is why we have a variety of stocks that we could potentially look at, because sometimes it just doesn't look good. Now, SPY, and this is also helping you to not get faked out, because a lot of people like to force trades because they don't see their key level is 100%. They're like, well, I want to trade tomorrow, so I'm just going to put this key level out of nowhere. And some people are going to put 130, but not me. Now, 544 is a clear example of a nice upside level for today. Without even looking at what it did today, reactions. Look, every time it comes up, it can't go above that, right? So what do you think happens when we're at that key level again and buyers are really showing themselves on that tape? Once we break that 544, it's absolutely going to fly. Why do you think every single time, like, look at this 1 hour chart. Look at where it went after it broke that 544. Why 544? Because of reactions. We want to see price reacting at a certain area, which means it can't go above or below that certain price point. And if it's struggling and it finally breaks out with enough buyers, what do you think happens? It's literally like a dam breaking. It's just going to explode. And that's exactly why we're able to make 20% in literally like a minute. Now, take a look at this. Another perfect reaction. I would take this to the downside. Like 544, like you could not get a more perfect breakout than this. We came up, reacted there intraday, which is super important, because you don't want to just take this after all of that, because, I mean, what are the chances it continues and continues like that, right? We want to see a pullback. It reacted at 544, pulled back, perfect. Now we want to see it come up. We come up, reacted again. We came up, touched 544, came down. Sellers were trying to show themselves at that 544, and buyers just proved themselves wrong. That time of sales I know was going crazy. Buyers came in, broke that 544, boom, right? And I would probably even mark out this high day area just to be sure that I see on the ask that it's able to break that 03 on the time of sales. Once it did, I'm in. And jeez, that thing absolutely flied. That's a huge percentage. That's like 50%. It's literally could have been 100%, honestly, right? 544 to 545, 50, probably 100% breakout right there in literally a couple of minutes. So that's an example of that upside. Now, just because it broke like that to the upside does not mean we could take that right to the downside, right? Number one, we're $3 away from that. Number two, you clearly can see the direction that SPY is going right now, but that doesn't mean it can't go down, right? Stocks either go up or down. And, you know, a lot of people like the trend trade and stuff like that. But if SPY picks a direction down for, you know, today, for example, or tomorrow, right, we came up, but I took a Q's downside trade today, right? Even though the entire market came up, I still made 35% on the downside. And how did I do that? We saw 480 come up, comes down, right? 480 was something I was looking at for a potential rejection point. Came up, faked everyone out, came down. So if it's not going to go up, then it's got to go down. I wait for the confirmation. You guys can see the reactions here. This is the intraday key level for the rejection at that 480. Then I get into puts, 35%. We literally sell on that 479 break to the downside. Boom. Sold literally the low of that move and literally the low of this huge move. Our sell was insane. But just because it came up like this, right, it most likely will continue tomorrow, but we can always have our key levels to the downside because let's say it wants to come down and the sellers are there, you can't have a bias, right? If sellers are there, sellers are there. Or it's not going to go up if there's more sellers than buyers. This is not how it works. So this is why we also could potentially have this downside key level. And as you guys see, this 484 is looking phenomenal to the downside. It most likely will bounce at this 484, but this is where time of sales comes in, where we're able to see if sellers are there versus buyers. And we're going to have our key level here and just wait. And then 487, perfect key level, all-time highs. 487, psychological level. 487 is the next psychological level, 14 cents away from all-time highs. We're also going to mark out 86 because we could potentially anticipate all-time highs of this 487 once we break this all-time highs. So we could add that as well. Boom. So now we got our upside and downside key levels on Qs. And you guys see how much cleaner this is compared to something like Tesla. So why on earth would I ever touch Tesla tomorrow or like try and make key levels for tomorrow when I could just skip that and I know maybe the next day it looks better, the next day it looks better, when I can focus my attention on this. Take the best, leave the rest. If none of these key levels were setting up for tomorrow, then I would literally wait tomorrow and look at intraday levels to see if it's potentially something that happened overnight to where pre-market is setting up a key level, but like it's not worth it. Sometimes you're just like, all right, listen, I'm going to stay on the market just in case something happens, if something sets up intraday, but like you can't really prepare anything on Tesla. It just doesn't look clean. You guys can see the reactions on Qs versus the reactions on Tesla. You guys see it perfect. Came up, retested at 484. It's looking clean already. Even though that was like maybe like 3 reactions or something like that, it's still the cleanest reaction because we came up and then this is where it starts struggling around that 484 and then we continued higher, right? Even down here at this 481, same thing. It looks good, but that's way too far for us to take. And it's just too far for us to take. So why plan all the way ahead like that when this could get broken pre-market in 2 days or whatever? So there's Qs, there's SPY, there's NVIDIA, and there's Tesla. Those are the 4 stocks that I also look at. But this is literally how I find my key levels to trade. We can go over one more, a random ticker. Let's see if SMCI, even though I already have my levels on there. So like even this, right? For example, reactions. Now, I could have a level at 920. That doesn't mean I'm going to take it, right? If I say I want to take 920 to the upside, that does not mean that I'm going to be able to take that. I need the time of sales to look good at that 920 level. But that's a potential price point that I would be able to take a trade at. Now, SMCI, you guys can see the clear reactions down here around that 750 area to 740 area. Right, that's a downside level that I would be willing to take. But again, we're worried about tomorrow. We can go over Apple. See Apple, perfect example right here, 220. Boom. Why? Because we came up, huge move to the upside, and guess where we stopped out? 220. We don't just stop randomly out of nowhere. These are psychological levels. 220, and then we came down, literally an H. If you guys ever heard me talk about H, is where we come up or come down, and then we pull back, for instance. It literally looks like a lowercase h, but inverted. And we came down, people taking profits, and then we come right back up. 220 to the upside, and then we want to watch for 220.2 on the ask. Why? Because that's exactly where we stopped last time. So if we could break out at 220, I'll take this to the upside, but I don't even touch Apple because there's better stocks out there. That's just an example of finding a key level and how we found that in literally 2 seconds. So if you guys enjoy these videos, let me know in the comments down below. Even though I made this seem super simple, it's more about the execution at those key levels that make it way harder to take a trade. But either way, your win rate's like at least a 60% win rate if you just buy it at the 220 break and not even know what time of sales is. Add time of sales and you start getting good at it, 80%, 87%. I have 87%, probably 90. I'm humbling myself, probably like 90 something percent at this point. Today, we're going to be going over exactly how I find my intraday levels, because it's one thing to find the key levels, but it's another thing to actually find key levels intraday. About 50% of my trades, you guys see, I find these levels intraday versus how I usually find my levels. And today we're going to go over exactly that. So the first thing that we need to see is a bunch of reactions. The way that I find my actual key levels is also reactions, but these are reactions on the 1 minute time frame up to the 5 minute time frame. These are levels that react. Now, in this example right here, as you guys can see, where do we see it reacting at the most? We have this one touch right here. We have this next touch right here, another touch right here, all reacting off of that area. So let's mark out a level right here, and we can make this a zone. So we have a zone right here. This is how I find my key levels, just the reactions right there. And what we could do is we could play either a breakout or a retest of that, or the 258 break. And that's exactly what we did. That 258 break to the downside into that 257. That's exactly how we found this key level intraday. Because on a 1 hour, it doesn't look that great, but intraday, it reacted so well, and it was in the first 2 hours of the day, which is great, usually within the first hour. As long as it reacts like that before 10:30, then I'll take it. If it does this and it keeps doing that after 10:30, then there's a lower probability, and I only want the A+ setups. So after around that 10:30 a.m. Eastern, if it keeps doing this, then I won't probably take it, but it was right around that 10:30, which is perfect. Another great example of these intraday moves is this 255. Yes, it's a psychological level, 255, but there was nothing really setting up there yet until that pre-market area, until that intraday. So it's different than looking at the 1 hour, because it could have been choppy previously. Based on these reactions pre-market, you guys can see right here, all the way right here as well. All these reactions is looking great. Then we reacted intraday as well. This is the intraday levels, right? We rejected off of that, came all the way down. The bigger the reaction, the better. We literally came up green, rejected 255, and then we went red, showing you guys that there's a lot of sellers in that area. And once we break out of that area, once we're able to get buyers over the sellers, what do you think is going to happen? We're going to explode. I think of it like a dam analogy. If there's enough water to break the dam, do you think the water, once it breaks, is just going to stop? No, it's going to flow out crazy, and that's exactly how breakouts work. Once the dam breaks, once the seller wall breaks, that's when this thing will absolutely explode. And that's how we know if we're going to get faked out right away or not, because of that dam analogy. Now, 255, we came up, rejected that again, came back down, little pullback, little H right here, went red to green. That 255, that's an intraday reaction. Number one from pre-market. Even if pre-market didn't exist, based off of this, huge move to the downside, then it recovers, rejects that, people taking profits, and we're still able to hold up. That shows you the flip of buyers in that area. Sellers stopped. They reacted at 255, showing that there was something there, and then we're literally reacting there perfectly. That's literally a perfect intraday reaction. The earlier, the better. This was in the first 7 minutes, which means that the volatility could easily bring this up alone, right? So if this happened at 10:30, it might be a little bit too slow. But because we had that flip of sellers and it came right to buyers, showing you guys that buyers are actually there, and then as well as the time of sales. And then what you could do if you missed it, right? The move happened without you. There's no FOMO. You wait for the next trade. What you could do is it's 255. Let's mark this out at 255. You can play it to the downside. How do we play it to the downside? We came up. Buyers are still here. We kind of rejected a high day area around that 257. Came down. You can't really take it like that just because that's the first touch, right? That's the first reaction there. But psychology, right? This is where the logic comes in with trading. If we come up, we break high day by a couple cents, come back down, break high day by a couple cents, and then come back down again. What does that show you about the area right there? It's weak, right? There's sellers in that area. We aren't as strong as we were. So if we can't go up, the only way we can go is down or sideways. So if buyers are trying so hard to bring this up and they can't, once the sellers gain enough control and absolutely bring this down, here we go. We had the reaction there. Perfect. We come down, green to red, closes under, you're in. Or another reaction, once it closes under, you're in. 255 came all the way down to 254, then all the way down to 253. You could have played the reversal of that, and that's a reversal breakout. Now, if you go like this, you put a minus sign in front of Tesla on Think or Swim, then we go to our chart right here. You know, a lot of people have a certain like bias in their head. So to make it easier, especially if you're starting the trade and you can't see this on the opposite side, if it's just a regular Tesla instead of negative Tesla, this could also help you by showing you guys this reversal right here. You know, because a lot of people can't think about that reversal in a different direction. So Think or Swim makes it easy and it shows you both directions. Buyers, right? Buyers holding this area, came up, rejecting that 255, showing that there's a wall there. And again, it looked nice intraday, came down, cannot go past the sellers, cannot hold this at all. Buyers keep trying to bring it up, bring it up, bring it up. Once these buyers let it loose and the sellers lose control, guess what happens? We come up, rejecting that again, but then we went red to green. Once we held above that, great entry. 255, great risk to reward, because if we can't go down, we've got to go up or sideways. So then buyers literally showed themselves they want to come up. And then once they were able to do that, look where we went, all the way to that 253. And last but not least, same thing here at this 486. Intraday reactions. Now, it would have been playable if this was at 1030, right? But we came all the way down, reacted at this 486. Right now, I'm just showing you guys reactive areas that you could potentially take a trade on. We come down, bounce off that 486. We're reacting. Now, again, this is why I only take it if it's before 1030, because it will just consolidate for a straight 3 hours. You know, everyone's out to lunch. It literally consolidated from 11 o'clock until 1:30, which is why it's like, if it's going to break, it got to break in that first 1 hour. But I'm just showing you guys a great intraday reaction. If this was before 1030, this 486 would have looked great to the downside, because we got these two very, very nice reactions. Now, if the 1 hour looks great, this is something that we could definitely play to the downside on the next day and have this level there on our watch list. But these are the reactions that I'm talking about. 46, there's obviously something there that allows sellers to like right under it, and then buyers immediately bring it right back up. There's something there at that 486. So once that's able to fully break, this thing will absolutely tank. And this is an intraday level that we're looking at. And then same thing with 575. Like, you don't have to make it that hard. I honestly think the key levels is the easiest part. It's about the execution, the time of sales, how previous price action is. But this video is all about just finding the easiest part of our plan, the key levels. 575, this is one of the easiest levels you can find. Literally, pre-market, 575 is a high. We go to the 1 hour, we check. Okay, all-time highs, 575, easiest key level to play to the upside. So let's say, for example, this came up, reacted at the 575, came down a little bit, people are taking profits, and then we come right back up. That's the exact A+ setup that I want. 575 was reacting pre-market. It's also all-time highs. It's also a psychological level. 0s and 5s are the best. And that's probably would have been a 20% trade once we break this. And now, since how well it reacted and all that stuff that I just mentioned, now we have that as our strong key level, 575 to the upside. So whenever it gets above there, we're going to take that to the upside as long as intraday looks great at that area. If you guys want me to make a video on previous price action leading up to the trade, a lot of you guys don't know that inside the candlestick is one of the most important information when it comes to your trading and increasing your probability. A lot of people just look at candlesticks for face value and they don't understand that you could actually read them like a book inside of the candle themselves. All you guys see is the opening and close. But today we're going to be dissecting previous price action and actually understanding each and every single candlestick leading up to our breakouts. And this will help you in any single strategy because this is basically helping you understand how stocks move in the first place. And if you're able to understand that, you're able to understand how to not get faked out and when to actually enter and exit and when to actually execute at the best times possible. So let's get right into it. All right, now let's go over a trade that we took for a real example. Take 350 to the upside on Tesla. Now, how can we read candlesticks and how can this increase our probability of not getting faked out and when to exit and enter at the right points? Because you guys see this broke 350, a lot of people will get faked out right here. How do we avoid that? Well, we have to dissect every single candlestick going into that move. What is price action telling us? Besides the time of sale, let's read into every single candlestick. We come down. Very nice, very sellable. We start to come down in the morning, as you guys can see right here. We start to come down, people taking profits, keep going down. Then, out of nowhere, these buyers come in and absolutely flip price action. So that shows us that sellers thought they were in control, and then once enough buyers came through, we flipped, and now sentiment changes. But then guess what? We come up and then we start to have this wick right here showing that buyers aren't as confident either to the upside. Sellers tried, and then once it got to that area right here, that's when it flipped. So sellers aren't in control there. We flip, and then buyers aren't in control there. So then it just keeps going back and forth. Next thing you know, we open up, and then we're still inside of this wick, and then we come right back down. So now it's telling us that it's just back and forth and there's no real move in one direction. And this just shows us that price action is not confident in one direction yet. Then we start to bounce off of this area right here, and then we start to come up. But guess what? These wicks happen again, showing us that buyers tried and sellers keep trying to bring back down. And then you could also see the body of the candle. Look how small that is. This was bigger, but then it got smaller. And this is a little bit bigger, but then we have a bigger wick, showing us that these sellers are still trying to take control in that area. Not confident enough for me to take any sort of move. Next thing you know, we come back up, and at this point, I am not entering because there's a higher probability of getting faked out because of this previous price action. It is so back and forth. These sellers keep bringing it down, bringing it down, bringing it down. There's no real signs of aggression. Even if you're looking at the time of sales, it was super slow, and then out of nowhere, it could have started popping up there. But again, that's not how we take a trade, and that just leads to a fake out. Next thing you know, this candle out of nowhere shoots up, highest candle closure of this whole entire time. But then guess what? We have this wick again. We're wicking right at that 350, come right back down. So now, basing it off of previous price action, this whole area, sellers are trying to take control in here. There is literally a fight between buyers and sellers. Then out of nowhere, this green candle, then boom. We have a higher probability of a fake out because of all of this, and we never had any real pullback. I want to see what happens when we pull back and then come up, right? We cannot break it like this, and especially after this candle, giving us that wick right here at the top of 350 and this small, very small candle body that shows that buyers were not able to progress whatsoever. But this candle showed progress from the buyers, and it just stops like that, showing that the buyers didn't really make any real progress, and we need to see a pullback to make sure that sellers aren't in control as much. Because one pullback, guess what happened last pullback? We dumped like that. What happened to the other last pullback? We literally dumped under both of those candles right there. So I want to see a pullback around this area and then go up. That shows me, number one, that's half of this candle. That's where it was trying to reject at. And I wanted to see it hold. So we see that increase in the bids. So we know that buyers are still continuing to bring it up. And sellers, when they have the chance, they don't just bring it right down. But guess what? We broke out of 350. And again, how do you tell not to get faked out? This previous price action, all of these circles tell me not to get in on this 350 breakout. Why? Because you literally have a 40% chance, 50% chance of getting faked out on this. So I'm not basing my trades off a flip of a coin. We have to wait for that pullback, and guess what? We broke under that, and we just absolutely died like that. Easy way to not get faked out is literally by looking at that previous price action and identifying what is going on at this 350, because the only way we can go up if there's more buyers there than sellers, and there's more aggressive buyers there than sellers. And looking at the previous price action, it literally tells you that in that story. Now, taking a look on a trade that I took today, we took that 339 to the upside. Now, what we want to see is how price action is getting to that point. Now, as you guys can see, price started reacting there intraday in that area, and again intraday in that area. And you might be wondering, yo, how'd you not get faked out? Because what I like to see is it come up and then a pullback and then go. Especially after a move from here all the way up to there. Again, looking at this previous price action, we came up, then came right back down, then came up. Who knows where it wants to go, right? Without looking at the time of sales, there's not a clear direction here of where it wants to go. Now, if we clear all of these out and then we see what's happening after, we rejected that. But guess what? We start to hold a little bit higher than we usually did, right? This was there. And then now we're holding a little bit higher than we usually were, showing that these buyers are starting to hold it up a little bit more. And these sellers aren't really in control yet. We had these two candles to the downside, which were really strong, but it still wasn't as strong as those buyers bringing it right back up. And then we were holding this area. Next thing you know, this candlestick goes from here all the way up to here, showing that the real buyers are stepping in on this candle. Number one. Number two, time and sales really showed that buyers were really coming in on this candle. That's how stocks move, is with buyers and sellers. So if we have a lot more buyers here than relatively, then we could assume if they're clearing every single level and we still see enough buyers coming in at this high day right here, then we could anticipate our entry and get in on that 339 just by seeing that we have an increase of buying pressure coming in. Next thing you know, this candle is absolutely exploding. The two candles before that showed that the sellers tried to bring it down, brought it right back up. Sellers try to bring it down, right back up. Next thing you know, this candle's absolutely exploding. We got in. This thing absolutely ran $2, then came right back down, retested 339, and exploded. That's what I like to see. That's the price action I want to see. Now, same thing here with Qs. Let's say we're looking at this 499 to the upside on Qs. What are we looking at? Now we're looking at this previous price action. You guys see it literally looks like a barcode. I can scan this in a self-checkout at Walmart because it's just so back and forth. So guess what? You just don't take a trade in that chop. You know, a lot of people trying to anticipate it or think they're heroes and getting in like here or whatever. And it's like, okay, have fun with your 40% win rate. Let's actually take an educated trade here. What is happening? So we came up in the morning, came right back down with this wick, and we start to bounce off this opening right there. This is the lowest it made, and we're still trying to bounce off this low day. And we come right back up, another wick right here, showing that buyers are still in control, bringing it up, little pullback, bringing it up, bringing it up, bringing it up. Now, obviously, we can't take a trade if we come all the way up to here, because that's $1 already. And if you guys know Qs, you guys know it doesn't just run $1 and just keep going. And if it does, then you already missed the move. You want to get in, for example, right here if that was a key level. But since it's not a key level, then you just don't get in. There is no way I'm getting in right here without a proper pullback. Guess what? We had a little pullback there. But what do we notice? We noticed that, number one, we came up. We're starting to see these wicks here, which is fine because the wicks, we are extended. The wicks are just showing that sellers are starting to come in at that area. We did literally have a $2 move from here to here with one red candle, one little pullback. So it was justified to have those wicks there. Then we had this little red candle right there, people taking profits. And then guess what? The high of this candle is $4.99, came up, came right back down, wick right here. Shows me that sellers are really starting to take control there, and we need an increase of buying pressure for us to take this relative to this candle and this candle. And we just didn't see it. It stopped in that same area that it did previously. Then we try to come up, right back down. So we know that 499 is a strong level, and this is perfect for a later trade. So whenever it breaks later in the day, hopefully by 11, because after 11, I'm not going to take it, I will be able to take this 499 with more confidence, knowing that there is a strong level there And as long as I see more buyers coming in than it was previously, then we have a higher probability of this to break. We come back down, up, down, up, down, literally go like this and pretend like it's not there and wait for it to come in that direction. Next thing you know, we start to come up, little pullback. Now this is the highest pullback in this area, right? We draw a box right around here. This is the highest pullback in this area. You guys see all these candles inside of this. Then we broke out of that, held that area. Then we start coming up. This candle is absolutely going. Buying pressure was there. I was watching this. Time of sales was going crazy. There was more buyers there than there was previously. And we had this pullback here. That's what I like to see, a little pullback. Nice structured candle. Next thing you know, another nice structured candle. No wick there, showing that these buyers just going like that. And this was a 50 to 60 cent move, which is around 25% of the contracts alone. It pulled back to around that 499 and then absolutely just kept going above that 500. Now, NVIDIA, same thing here. We can see buyers came in the first 2 minutes, then sellers try to bring it right back down. Guess what? Buyers are able to hold those lows right there, and then we came right back up with aggression. Then people taking profits. This is great price action. Then we came right back up, and then we have this wick right here, and then we have another wick right there showing that, you know, sellers were there, and then sellers try to bring it down, and then they brought it right back up. Sellers try to bring it down, buyers brought them right back up. But what you guys notice is these candlesticks are starting to get a little bit smaller, showing that we are extended and these buyers aren't really pushing as much as they were previously. So if there's any key level here, I'm not going to be able to take it because it's showing a slowdown and it's showing that buyers are starting to get less aggressive. And I can't expect those aggressive breakouts, as you guys see in my videos, if we are getting slower and slower and slower. So what needs to happen is we come up, people taking profits, and then we go. Guess what? Didn't happen. So now we know that that 143.5 is looking good. We want to see some reactions right next to it. Next thing you know, we have the highest candle closures in this area, right in this area. But we have this wick right here. So it's a little bit tricky when we have these wicks, but we aren't close enough yet to where it's like, okay, because we still have around 10 cents of room for buyers to show themselves. So we know we have a higher chance of not getting faked out. So we have this wick right here, which literally creating a bigger zone up here. And we have to see what it does in this area. Next thing you know, red to green. Next candle, red to green, pushing through that wall like it's nothing. Buyers really showing themselves in this area on the time of sales. Buyers are really coming in. Compared to this, to that, it was a huge difference. Buyers holding these bids up. No signs of buyers losing those bids. They keep bringing it up, bring their limit orders up, and then just smashing through these asks. The sellers are not able to hold off at all. And these buyers just coming in crazy. Next thing you know, we break this, but then we have this little wick right here. Then this candle body gets a little bit smaller, and then we have a bigger wick. Then sellers try to strike, bring it right back down. Next thing you know, buyers absolutely came in there, exploded to the 80s. Then after that, we have this wick right here. We're starting to hold off a little bit. This is where I'm mostly out. And then we came up, a wick again, came right back down. Now, if sellers really wanted to, they should have dropped it here. But guess what? Buyers were able to hold these 80s very strongly and then came right back up. Sellers tried to bring it down, came right back up. Literally red to green, and then we just explode into that 144. This is where I'm 90% out just because we already had signs of struggling. We already had a little bit of signs of struggling there. That's why we took half off there. We already have signs of struggling right in that area, and then we explode again. Once we see more signs of just trouble, that's how you know it's just going to do that consolidation thing that it usually does and just go back and forth in that area anytime now. And I'm not going to be stuck in a trade for an hour for the same exact percentage. I'm going to be 90% out. And then once it clears under this low right there, which it did right there, I would be fully out because I'm not trying to be a part of a back and forth game. And let's see exactly what happened after. It probably went back and forth. It did, back and forth, because that's the breakout And that's where most of the energy comes from. And it gets expelled there. And then that's it. That's it for the rest of the day, usually. And it would just go back and forth or like slowly grind up or slowly grind down. This is not how I trade. So if you guys learn anything, I've made more than $1.2 million from trading this year alone, thanks to one indicator that's literally so simple, it kind of feels like cheating. So today, I'm going to break down everything I know about it and show you live examples of how I use it so you can do the same. Time and sales, otherwise known as tape, is an indicator that shows orders coming in real time, unlike most indicators that are lagging. The first thing you need to know to use this as a cheat code is liquidity/walls in the market. There are two different types of orders in the market. There's limit orders and there's also market orders. Limit orders, you can set the exact price you want to buy or sell at, oftentimes having a wait time to get your order filled. Market orders, however, are aggressive orders that fill almost instantly because they fill at the current market price. There are orders waiting at every price of a stock. The market orders buy and sell through limit orders, and the amount of limit orders at a specific price needs to reach zero before the market moves to the next price, which means market orders are what moves the market. Like I said, there are limit orders at every price point, but most price points are insignificant and can be passed through since there aren't many orders waiting to be filled. However, in this example, there are 5,000 shares with ask at $500. You can clearly tell here that $500 is a significant price due to the amount of orders sitting there and price reversing off of it repeatedly. This is what I call a wall, or I often call them key levels on my channel. It is the market's buyer's job to remove the limit sell orders at 500 by buying 5,000 shares, and then the price can continue up to 500.1. Once all orders at 500.1 are removed, we can continue to 500.2 and so on. The way we use tape alongside this concept of liquidity is we need to see the tape show orders coming in at that level. Market buyers will always buy at the asking price of limit orders, and market sellers will always sell at the bid of the market buyers. So in this case, we need to see buyers hitting the ask at 500 on the tape to show that the buyers are chipping away at that seller wall. However, we don't just buy once the tape shows us that our price is getting hit. We need to see momentum in our direction to make sure we can actually break that wall and not fake out. This is where momentum comes in. Momentum on the tape is made up of two things: speed and aggression. Speed is how fast new orders are coming in on the tape, and aggression is how far price is progressing. Speed and aggression can come in separately, but I tend to look for them both to come in at the same time. Now, understanding how to identify momentum correctly will make or break how useful time sales is for you. Here is what momentum looks like on the tape. As you guys can see, it's being very slow. Then out of nowhere, the relative velocity starts to increase. As you guys can see, look how fast these orders are coming in real time. Look at that. Compare that to how it was originally. Look how slow it is. And then it just starts to speed up out of nowhere. That's the momentum that we like to see. Taking a look at the time of sales on the right, you guys can see how slow this time of sales is moving. Even after it broke, there was no sudden change on the velocity whatsoever, indicating that this is potentially a fake out and the probability is not high enough for me to take that. On a surface level, momentum is pretty easy to see and understand, and to dig deeper and fully understand how to use time and sales as a cheat code, you need to understand one more simple concept. When you take a look at past price action through candlesticks, you can get a clue of how price will behave in the near future. This same concept applies to the same way with time and sales. The way time and sales behaved as price got to your trade idea is super important to your probability of winning. I call this relative velocity. This is all about how fast those numbers in time and sales are moving compared to what we've seen before. If things were cruising along slowly and then suddenly start to pick up speed, that's a sign that relative velocity is increasing. The main way people get faked out is through flashes of the time and sales. This is fake momentum. What we just talked about was the previous price action and the velocity of it. Take a note of how slow this time and sales is moving right now. Very slow, no sudden change in momentum, and then out of nowhere it flashes. That is exactly what we talked about, is a recipe for a fake out, and you don't want to take that at all. Let's take a look at this relative velocity. Look how slow the time of sales is. Again, very slow, not fast whatsoever in any way. Relative velocity is still the same as it was previously as we're getting to this level. Very, very slow. This increases the chance of a fake out, and this is something that you don't want to take whatsoever. And then out of nowhere it flashes. That again is a recipe for a fake out. Doesn't matter where it wants to go after that. I'm just not going to be in that because the probability of it being a fake out is so high, as you guys just saw right there. Real momentum literally just means that the majority of people are trading the same direction as us. When we get a flash of momentum, this means that only a few people are looking at it and not the masses. A flash happens when the velocity spikes out of nowhere and then drops back down. This is where you need to understand previous behavior of the tape in order to not get faked out. If you notice a flash at a key level after a period of slow momentum, that could be a warning sign of a potential fake out, and it might be best to just hold off on that trade entirely. But if the relative velocity was already higher than previously, and then you see a flash at that key level, that's your signal to go for it. By using the concept of previous price action in the tape, you could really minimize the risk of getting faked out, which is crucial for boosting your win rate. Now here's some examples of live trades that I took. You guys can see the velocity is already increased. You guys can see that it's actually increasing a little bit more, and it's getting faster and faster and faster. Look how fast this is. That's the momentum we like to see. And then we want to see that flash right at this 570. Boom. That's the momentum we like to see. That's why I just got in that. And this is why it has a higher probability of not being a fake out. And as you guys can see, we come all the way back down, which is exactly what we wanted to happen. And I ended up making $11,200 on that move. Like I said previously, we want to see that relative velocity increasing, as well as the momentum also being there, as well as aggression on this time of sales. So let's go over this and see if relative volume increases, if there's a momentum increase, or if there's aggressive price action. Pretty slow so far. A little bit more of an aggressive price action starting to come in, but not a lot. We broke 488, really did not see any sort of difference. We were moving a little bit on the time of sales, and we have a little bit of an increase in relative velocity, but not as much as you would like. Even though I did take this trade, this was eventually a fake out because the momentum kind of wasn't there. And as you guys can see, that was a clear fake out. Right back up. We got stopped out for around like 8% or so, but that move just showed that relative volume did increase a little bit, but it was the same increase when it was in the 20s as when it broke 488. There was no difference. All right, now we're going to take a look at this velocity. You guys can see how fast this is going. Relatively, this is looking great because previous price action showed that it was a little slow. Look how fast this break was at that 135. That just showed us that extra confirmation that this is going to be a banger. Momentum's coming in. The tape is moving. Velocity is there. Relative to previous velocity, it just keeps increasing, showing that the buyers are there at this 135, which is looking absolutely phenomenal on this move. This should just increase your confidence even more on this trade and has a very, very high probability of continuing, and that's exactly what happened. All right, as you guys can see, this relative velocity is not really there. Look how slow this time of sales is moving. Very slow. It's not really moving a whole lot. Starting to increase maybe a little bit, literally nothing. And then out of nowhere, a flash. I don't care if this thing keeps going or what. That relative velocity is not it. As well as that breakout with that flash, out of nowhere it flashes like that. I usually do not like that whatsoever, but I took it. There's always exceptions, but for a high probability trade, you don't want to take that. Usually. That's a very good fundamental just to base your trades off of. And as you advance, you could make exceptions. There's always exceptions to everything. But for the main thing, just don't even take a trade like this. And this is probably a fake out. Yeah. So he could learn from this video as well. Like I said, relative velocity is very slow. And then out of nowhere flashes like that. Not a good chance it's going to continue whatsoever. There's always exceptions to everything. But to keep your win rate as high as possible, only take the best. Don't do what he just did. Now that we know how to take a trade, where do we take a trade at? Because it's not so, oh, I think it's going to go down, so I'm going to enter. Oh, I think it's going to go up, I'm going to enter. No, it's way harder than that. We have to go through every single step of a trading plan for us to execute. Now, the first step is identifying what strategy you're going to be trading. Now, for this example, I'm obviously going to use my own strategy. Now, the first thing we need to know is what is our position size, what is our risk, and how do we manage all that? So let's say our strategy tells us at most we're going to lose is negative 10%. This is my exact strategy. If I know I'm going to lose negative 10%, how much money am I willing to risk on each and every single trade? Now, it's not your position size, it's how much am I willing to lose on this trade if I'm wrong. Let's say, I'm starting out. Let's say at most I want to lose is $100 per trade, right? Could be higher, could be lower. That's the most that I would do if I first got started. Less is best. Now, this would require me to have a position size of $1,000. That does not mean I'm risking $1,000. What I'm risking is this. If I lose 10% on a trade, I would lose $100. So now we figured out our risk was negative 10%, which is $100, because our position size is $1,000. So now if I had a position size of $1,000, every time I take a trade, I'm only going to lose $100, which is at most I'm going to lose. If I had a position size of $2,000, that means I'm comfortable losing $200 per trade. You have to think about your risk before you do any of this. If I'm comfortable losing $500 per trade, which you should never if you're first getting started, but let's say you're at a point where you're able to lose $500 per trade, my position size is at most $5,000 because I know that my risk every time I lose is negative 10%. So now we know our position size. Now we know our risk. Our reward is going to be at least a 1-to-1 risk to reward. Where do we apply this knowledge at? And it's starting with the strategy. So my strategy is breakout momentum scalping. The way that this works is I could be in and out of a trade in less than a minute, right? I'll make 20% in 1 to 2 minutes. It's a faster paced way of trading, but it's not as fast as a lot of people think it is before they start. Because once they start the strategy, they realize that it's actually not that fast and it's perfect for them. But a lot of people get scared when they first hear this or first see this and they're like, oh, this is way too fast for me. It's not. I mean, you guys saw how quickly I was able to put the contracts up. You don't even need to do all that. You just have the contracts ready to go. All you do is click buy once our parameters are hit, and then you can just click sell once your parameters are hit. As fast as you click a button is as fast as you can get it on the way that I had it set up. But let's go over the strategy. The first step of the strategy is our key level. And what is a key level? It's just a price point where price is reacting at. And if you're new, what does that even mean? If price is reacting at a certain level, that means that it stopped. As you guys can see, it kind of stopped here and then had a reaction. It bounced off of it. See how it just went crazy? Because it was able to break out of a key level. And key level 412, for example, what happened when price got above 412? We went up $18. What happened when price bounced off of 415? We went up $20. So seeing all of these reactions will help us identify where we could place trades at. The more reactions, the better. See how price came down, bounced off 415, came down, reacted, and bounced off 415. I would be interested in taking this to a downside level. And you must be like, oh, well, if it bounced, why wouldn't it just bounce again? It can, but here's the thing. This leads us to step 2. In order for us to play a breakdown, right, which is a breakout, we need to see a ton of sellers coming in this area versus previously. And how do we see that? If you could see what buyers and sellers are doing at specific price points, then you'll be able to know if this is going to bounce or break down. Is this going to break out or is it going to reject, right? As you guys can see here, it rejected. You could see all of that based off seeing real-time buyers and sellers, which is why I have no indicators on my chart. If I could see what buyers and sellers are doing real time, you'll know what it's going to do at that level once it's at that level. For example, if there's a ton of sellers coming in at 415, do you think it's going to bounce? Versus previously, if buyers were coming in at that 415, do you think it's going to go down? No. Buyers are holding that area. Sellers, if they coming down here and are coming in crazy, then we have a very high probability of continuing lower. It must be like, okay, how do we see where buyers and sellers are doing at a certain area? This right here is time and sales, aka the only indicator that I use. This is showing real time buyers and sellers coming in. This is the reason why I'm profitable, is because I'm able to see buyers and sellers coming in real time. Now, this is a software called DAS, but you could use a free version right on your Thinkorswim. This is also the time and sales. Buyers and sellers coming in real time. Now, I don't go based off the color. I go based off two things: aggression and velocity. How fast are these orders coming in and how aggressive is it moving in one direction? For example, you guys can see on the bid and ask, the ask is at 920 and the bid is at 78. We're not going anywhere. We've been at 919.78 forever. Same thing here on the ask. We're at 920. We're not moving anywhere. There's no aggression and it's slow. We're starting to pick up a little bit, but this is not anywhere near what we want to see when we're taking a breakout. But just know this is the only indicator that I use. I'm not going to turn this into a whole time and sales lesson, but what I want to show you is the aggression and velocity that I'm looking for. And this is how it helps us with trading. Look how faster this is moving, right? These are all the market orders coming in. And if there's a ton of market orders coming in, the way that I trade, there is a big wall sitting at 135, for example. Now, these are all limit orders waiting to be executed. The reason why breakouts work so well at these certain levels, like for example, that 415 that I showed you, was because there's so many orders waiting to be executed that price is not able to break above or below it. The reason why we're looking at this is because if price wasn't able to break above it, it wasn't able to execute all those shares at that specific price point. What needs to happen is we need to see a ton of market orders coming in for us to be able to break out of that 135. That's why I look for the speed. That's all market orders coming in. I also want to make sure that the speed is not in the wrong direction, which is why I look for aggression. I want to see it hit 134.80s, then 134.90s, and just keep going up and up and up as fast as possible. We're at 98, 99. Look how fast this is. 20s, 30s. Look how fast that is, right? It broke out, and this is one of my students' trades, right? Look how fast it broke. That right there broke out 30 cents. And look how aggressive it is, right? We were at 135, then we were in the 10s, 20s, 30s. Look how fast it is. And he's already up 7%. If you got in at 135, you would have been up 20% because I took this exact trade. Look how fast that went. That's exactly why I use this and nothing else. He also has no indicators on his chart. And as you guys can see, ready? 30s. Now we're in the 40s. Now we're in the 50s. Like, look how fast it is. And he's already up 13%. That is basically how you can start to trade options. Most traders think they need more confidence. In reality, they don't. They need conviction, and it's not the same thing. Confidence is a feeling. Conviction is a system that is executed with discipline. And that's exactly what we're going to go over today. And it's the difference with mindset that will allow you to become a profitable trader, because I could be profitable with any single strategy out there because I developed a profitable mindset. I can give you the exact blueprint and everything you need, and you still won't be able to execute how I execute because how I think about the trade, my mindset with the trade. And you guys want a mindset of a killer. We are probability managers, right? Your job isn't to be right. It's to execute with your edge. What is your edge? What makes you a profitable trader? For me, it's how I manage risk. And it's my ability to really read the time of sales and see that order flow coming in real time. And you guys want to detach from the outcome. Who cares if you lose or win? It's all just numbers, right? You guys want to continue to keep executing the same exact strategy over and over and over again and not get caught up on the outcome of one trade. And that's where obsessing over the process really comes in. You guys want to obsess over becoming the best trader possible. If you guys are just trading just to make money, you'll never become profitable. I saw a quote from Alex Ramosi that said, if you guys are just walking to reach your destination, you're going to walk less than the person that walks because they enjoy walking. Same thing with trading. If you guys genuinely enjoy trading, you guys are going to become really great traders because you're going to obsess over trading. Like I said in the beginning, confidence, you don't need that, right? You guys need conviction. Confidence is emotional. Conviction is procedural. Here's my checklist. This is my conviction. This is what makes the A+ setups. Okay, if I see all these parameters, I'm entering. Not about how I feel. Oh, I feel confident on this trade, or I don't feel confident on this trade. That has nothing to do with the trade. The trade doesn't care about your feelings. So why should your execution take after your emotions? If you're break even, or if you're a little bit down, or you're a little bit up, this applies to you guys greatly. This is what's going to bring you over to the top where you guys are going to be profitable. You guys are still trying to be right. You guys are so scared of being wrong that you guys hesitate on trades to avoid being wrong. You guys gotta get over that. I don't care if I'm wrong on the trade. I don't care if I'm right on the trade. All I care about is trading the same plan over and over and over again. I'm not trying to be right on the trade. I'm trying to execute my plan to the best that I can. And if I take that loss, my risk is already there. You guys wait for the perfect conditions in order to enter. I wait for my A+ setups in order to enter, my checklist in order to enter. Not if the VIX is under 25 or the ATR is ×2 what it usually is, or if this or that or this. No, that's analysis paralysis. You guys are waiting for too many conditions, too many filters in order to enter on the trade. You're doing too much. Now, how do we build conviction? It's built with reps. What I want you guys to do is replay those A+ setups until your mind knows when to strike. If you keep watching the film more and more and more and more, you'll start to notice that this is what an A+ setup looks like, and this is what a B+ setup, this is what a B setup, this is what a C setup looks like. Now, I want you guys to stop having this victim mindset. You guys are the reason why you're not profitable, not the market. I want you guys to take accountability for yourselves. You're not getting shaken out in the market because the market is after you or the market makers are watching you. You're getting shaken out because you're letting the market bully you. The market is a mirror that reflects how you treat discipline. You don't size up because you don't trust yourself. You exit early on the trade. You take profits really quickly because you hate being wrong. You watch great A+ setups go by because you always want more confirmation. Now, you guys wait for the perfect conditions, right? Every great trade has a risk and it will never 100% line up. This is how trading is. It's not a 100% win rate. Now, there's no such thing as a trade that feels certain, because when you are certain that it's going to go, it's probably too late, because the only way you're going to be certain on the trade is after it breaks out, after it went, which leads to you guys either missing moves, chasing the move, and you guys are getting paralysis by analysis. The analysis paralysis that I just said earlier, with too much stuff going on, you guys just freeze up. You guys don't know what to do anymore because there's just too much information. You got to make it a little bit more simpler for yourself. Now, it's also about how you guys journal your trades. You guys review emotionally and not structurally. Saying that trade sucked will not help you at all. Journaling is supposed to help you become a better trader. How does journaling I sucked, or that trade sucked, or I thought that wasn't going to go, or I shouldn't have done that. What? Shouldn't have done what? Right? Why are you trading and journaling this emotionally? Right? This is just emotionally journaling. I had a feeling it would fake me out. Is there any parameters that told you that? Right? Why'd you get in the first place? Right? You had your A+ setups and you had your checklist. Okay, you get in, and if it goes and fakes you out, okay, there's your stop loss, but you got in because your A+ setups told you to. Why are you getting mad at yourself for taking a loss? I had a feeling it would fake me out. Was there any red flags that you missed that led to that fake out? If not, move on to the next trade. Conviction versus confirmation. I want to keep reiterating this. Confirmation is like running a marathon with crutches, because by the time it looks good, the trade's already gone. If you need the trade to prove itself before you enter, it's going to be too late. Every single trade, you guys know there's a risk. And conviction is from preparation. Conviction is not a feeling, it's a decision. It's a decision to have your A+ setup checklist and to get in once you see all those parameters are met. It's to get in without hesitation and have everything defined. Your stops, your entry, your exits. You didn't know the outcome of the trade. You trusted the process. I don't know if I'm going to win or lose on this trade, but I trust the process because I have the reps. For example, if I am taking a break on SPY that 535 with speed, the previous price action looks good, it has a great level on the 1 hour time frame, and it's in the first 30 minutes of the day, let's say that's an A plus setup. It meets my rules. So I press buy. That's it. I wasn't like, oh, well, I feel like this might not go, or I feel like this is a fake out. No, I get in because I know the risk associated with this, and I know this is my A plus setup. That's it. Boom, I'm entering. And I'm not trading off feelings, right? I'm trading off a system that has kept me profitable for this entire time. And you're subconsciously searching for certainty, which doesn't exist in an uncertain market. You don't know what's going to happen next. You could have a 99% chance that it's going to go up, and there's still a 1% chance it might go down, and it could go down. But you're prepared for that. You're not looking for the trade to look good. Oh, this looks really great. I'm going to get in that. No, you're looking for the trade to match your system, match your parameters, and that's when you enter. I decided to write down some stuff that go hand in hand with conviction and confirmation, so you guys could really know the difference. Now, confidence waits for proof. Conviction pulls the trigger. Conviction shows up no matter how you feel. Confidence needs reassurance. Conviction needs a checklist. Confidence asks, what if? Conviction says, let's go. Confidence waits for the market to prove it. Conviction waits for the signal to fire. Confidence is built from winning, and conviction is built with reps. Confidence says, I hope this works, and conviction says, this matches my system. What you guys don't need is more confidence. What you guys need is conviction and an actual system. Now, if you guys want to be profitable traders with an actual system and not just trade based off emotions and actually trade the right way, I host these kind of lessons almost daily in my trading community, which is the first link in the description. We go over all of this stuff because we actually want to make people profitable traders. And if you guys enjoyed this video, make sure you guys subscribe, leave a like, and I'll see you guys in the next one.